Okay, so you want to own a commercial bank, buy a nice building on a busy corner, put a massive steel vault in the back, take people's deposits, loan that same money out at a higher interest rate, and watch the cash roll in every time someone buys a house or expands a business. It sounds like the oldest, safest, and most predictable business model on the planet. You're literally holding the money. But here's the strange part. A modern commercial bank is one of the most fragile, heavily regulated, and mathematically terrifying businesses you could ever possibly attempt to build from scratch. It is a business where the product you sell is identical to the product every single one of your competitors sells, where your inventory can legally leave the building at a moment's notice, and where a single rumor on social media can completely bankrupt you in less than 48 hours. Even if you did absolutely everything right, by the end of this video, you will know exactly why the bank down the street is not actually in the business of holding your money. How a commercial bank makes its profits on a concept that breaks most people's brains, where your deposits are actually a massive liability. Why the software that runs the entire global financial system is built on code that is 40 years old and controlled by an oligopoly you have never heard of. And why the business that everyone assumes is printing money is currently sitting on billions of dollars of unrealized losses, completely terrified of an empty office building. Let us start with what it actually takes to get into the business. You cannot just rent a storefront and hang a sign that says bank. To legally take deposits in the United States, you need a charter, and obtaining a de novo bank charter is one of the most grueling bureaucratic marathons in American capitalism. You have to apply to the state banking authority or the office of the comptroller of the currency, and crucially, you have to get approval from the Federal Deposit Insurance Corporation, the FDIC. The regulators do not care about your marketing plan. They care about your capital. You need to raise anywhere from $20 to $30 million in initial capital, just to prove you have enough of a cushion to absorb the losses. You are mathematically guaranteed to take in your first few years. You will spend millions of dollars on specialized banking lawyers and consultants before you ever open a single checking account. The regulators will background check your entire board of directors, scrutinize your lending policies, and demand a multi-year financial projection that proves you will not recklessly gamble with federally insured deposits. But let us say you get the charter, you have the money. You are officially a bank. The very first thing you discover is that you do not actually control your own technology. You would think a bank writes its own software to track all that money. They do not. Almost every small to mid-sized bank in the country rents its core banking system from a tiny oligopoly of massive financial technology companies, primarily Fiserv, FES, and Jack Henry. This core system is the central nervous system of your bank. It processes the deposits, calculates the interest, handles the wire transfers, and updates the general ledger. And it is shockingly expensive. A core processing contract will run you millions of dollars a year, and you are locked into rigid 5 to 10 year agreements. The underlying architecture of these systems is often built on COBOL, a programming language from the 1960s. Why? Because it works. It rarely crashes, and regulators completely trust it. But it means that you, as the bank owner, are entirely beholden to a massive vendor. If you want to launch a slick new mobile app feature to compete with fintech startups, you have to wait for your core provider to build the integration, and they will charge you an exorbitant fee just to turn it on. You are not a tech company. You're a highly regulated franchise renting legacy software. Now, we get to the question that actually matters. Where does the money come from? This is the part that breaks people's brains, because accounting for a bank is the exact mirror image of accounting for a normal business. To you, the $100 you put in a savings account is an asset to the bank. Your $100 is a liability. It is a debt that the bank owes you. The bank pays you interest on that liability. Let us say 2%. The bank's actual assets are the loans it makes to other people. If the bank takes your $100 and lends it to someone buying a car at 7%, the bank's asset is that car loan. The entire business model of traditional commercial banking lives in the gap between what they pay you for your deposit and what they charge the borrower for the loan. The industry calls this the net interest margin, or NIM. If your bank holds $1 billion in deposits, and you pay an average of 2% interest to those depositors, your cost of funds is $20 million a year. If you lend that $1 billion out at an average yield of 6%, you generate $60 million in interest income. The difference between those two numbers, $40 million, is your net interest income. From that $40 million, you have to pay your staff, pay the rent, pay your technology vendors, cover your regulatory fees, and set aside a massive pile of cash for the inevitable reality that some of those borrowers are going to default and never pay you back. What is left over at the very bottom is your profit. That is the fundamental engine of banking. You're buying money at wholesale prices and renting it out at retail prices. But here's the trapdoor. You're playing a game called maturity transformation, and it is the most dangerous game in finance. When you deposit money in a checking account, you have the right to demand that money back tomorrow morning. The bank's liability is short term. But when the bank makes a mortgage loan, they are lending that money out for 30 years. The bank's asset is long term. You're borrowing short and lending long. As long as interest rates stay relatively stable, and as long as everyone does not ask for their money back on the same day, this mathematical illusion works beautifully. The bank relies on the law of large numbers. They know statistically that only a tiny fraction of depositors will withdraw their cash on any given Tuesday. So they only need to keep a small percentage of cash in the actual vault. This is fractional reserve banking. But what happens when the math aggressively turns against you? What happens when the Federal Reserve suddenly raises interest rates at the fastest pace in 40 years? This is exactly what happened in 2022 and 2023. And it is the reason Silicon Valley Bank collapsed in a matter of hours. When a bank takes in billions of dollars in deposits, they cannot always find enough people who want to borrow it. So they take the extra cash and buy the safest asset in the world, United States Treasury bonds. Let us say your bank bought $1 billion worth of 10-year government bonds paying 2% interest. It is perfectly safe, guaranteed by the government. But then the Federal Reserve raises rates to fight inflation. Now, brand new government bonds are paying 5% interest. Suddenly, your old bonds paying 2% are fundamentally worthless to anyone else unless you sell them at a massive discount. On paper, your bank is sitting on hundreds of millions of dollars in unrealized losses. Normally, this is fine. If you just hold the bonds for 10 years, the government pays you back the full face amount. But remember your depositors. They see interest rates going up. They realize they are only getting 1% in their checking account, but they could be getting 5% in a money market fund. So they start pulling their money out. They want their cash. But your bank does not have the cash. It is locked up in those 10-year bonds. To give the depositors their money, you have to sell the bonds. But because the bonds lost value when interest rates went up, you have to sell them at a massive loss. The moment you sell them, the unrealized loss becomes a realized loss. It wipes out your bank's equity capital. The market sees your equity dropping. Panic spreads on social media, and suddenly, every venture capitalist and corporate treasurer logs onto their mobile app and wires their money out simultaneously. In the old days, a bank run meant people standing in line around the block in the rain, which gave the bank time to literally drive armored trucks full of cash to the branches to calm the panic. Today, a bank run happens at the speed of fiber optics. Silicon Valley Bank lost $42 billion in a single day. The building did not burn down. The loans were not even defaulting. The math just broke, and the confidence evaporated. That is the existential terror of owning a bank. Your survival depends entirely on the psychological confidence of your depositors. Because of this inherent fragility, the federal government does not let you operate freely. You are subjected to a shadow cost so immense that it consumes almost the entire focus of modern bank management: compliance. Since the financial crisis of 2008 and the tightening of anti-money laundering laws, commercial banks have essentially been drafted as an unpaid, heavily penalized police force for the federal government. You are required to implement incredibly complex Know Your Customer or KYC protocols. If a drug cartel washes money through your bank, or a sanctioned foreign entity routes a wire transfer through your systems, the government does not just send you a warning. They hit you with fines in the hundreds of millions or even billions of dollars. Bank of America, Wells Fargo, and JP Morgan Chase employ tens of thousands of compliance officers whose entire job is to monitor transactions, flag suspicious activity reports, and ensure regulatory adherence. These employees generate absolutely zero revenue for the bank. They are a pure cost center, but they are the only thing standing between the bank's executives and federal prison. For a small community bank, the cost of hiring enough compliance officers and implementing the necessary monitoring software has become so suffocating that many of them have simply given up, deciding it is easier to sell the bank to a larger competitor than to try and keep up with the regulatory avalanche. And you do not just pay for your own compliance, you pay for the failures of your competitors. Every FDIC insured bank in the country has to pay quarterly assessments into the Deposit Insurance Fund. This is the pool of money the government uses to make depositors whole when a bank fails. When large regional banks collapsed in 2023, the FDIC drained billions of dollars from that fund to cover the uninsured depositors and prevent a wider panic. To refill that fund, the FDIC levied a special assessment on the surviving banks. You can run your bank perfectly, take zero bad risks, maintain flawless capital reserves, and you will still get a multi-million-dollar bill from the federal government to clean up a mess made by a reckless competitor 3 states away. It is the only industry where the survivors are mandated by law to pay for the funerals of the people who tried to put them out of business. Then there's the quiet crisis lurking on the balance sheet of almost every commercial bank in the country right now: commercial real estate. A massive portion of a regional bank's loan portfolio is tied up in commercial real estate loans, specifically office buildings and retail centers. During the era of 0% interest rates, banks funded the construction and purchase of incredibly expensive downtown office towers. The loans were usually structured as 5-year or 10-year balloons, meaning the borrower pays mostly interest for a few years and then owes the entire massive principal balance all at once, which they usually pay by simply refinancing the loan. But in 2026, the world has fundamentally changed. Remote work hollowed out office occupancy. Buildings that were once valued at $100 million are now half empty and appraising for $40 million. And interest rates have doubled when that balloon payment comes due. The borrower cannot refinance because the building is worth less than the loan, and the new interest rate would bankrupt them anyway. They hand the keys back to the bank. Suddenly, your bank is the proud owner of a depreciating, empty office tower that costs millions a year in property taxes and maintenance. If the bank writes down the value of the loan to its true market reality, they have to take a massive loss against their capital reserves. If they take too many of those losses, regulators swoop in and shut the bank down. So instead, the industry plays a game called extend and pretend. The bank quietly extends the timeline of the loan, modifies the terms, and pretends the asset is still worth what it was 5 years ago, praying that interest rates fall before the regulators force a reckoning. It is a slow-motion avalanche hanging directly over the entire commercial banking sector to combat this margin compression and the massive risk of lending. Banks have spent the last 2 decades building a completely different revenue engine that does not require any capital at all. Non-interest income, better known as fees. This is the money a bank makes that has nothing to do with making loans. Wire transfer fees, monthly account maintenance fees, overdraft fees, wealth management advisory fees, and the quietest, most profitable engine of all, interchange fees. Every time your customer swipes their debit card to buy a coffee, the coffee shop pays a small percentage of that transaction to the payment network, and a piece of that flows directly back to your bank. It looks like pennies, but spread across millions of transactions a day. Interchange revenue is a massive, risk-free river of cash that falls straight to the bottom line. You are not putting any of the bank's capital at risk. You are simply taxing the velocity of money. The most profitable banks are the ones that have diversified away from purely holding loans and heavily into wealth management, treasury services, and payment processing, where the margins are pristine and the regulatory capital requirements are non-existent. And that brings us to the ultimate constraint on your growth: capital requirements. In almost any other business, if you find 100 great customers who want to buy your product, you just sell it to them in banking. The regulator dictates exactly how much business you are legally allowed to do through a framework called Basel III. For every dollar of risk-weighted assets your bank holds, you are required to hold a specific amount of your own Tier 1 equity capital. If you want to make $10 million in new loans, you cannot just use deposited funds. You have to have a certain amount of your own shareholder equity sitting on the balance sheet as a shock absorber. This means a bank cannot scale infinitely just by taking in more deposits. Growth is literally capped by your retained earnings. If you grow too fast, you have to go out and issue new stock, diluting your existing ownership just to satisfy the regulator's math. The entire goal of bank management is optimizing the return on that highly constrained equity, finding the perfect balance between risk, yield, and regulatory capital charges. So, time to pull it all together and answer the actual question. How much money do you make if you actually buy a commercial bank? Two scenarios. Real numbers. Scenario 1. The small community bank. You have $500 million in total assets. You operate 5 branches in a regional suburban market. Your primary business is making loans to local dentists, real estate developers, and small manufacturing businesses. Your net interest margin is squeezed tight, sitting around 3.2% after paying your tellers the massive bill to your core software provider and your small army of compliance officers. Your return on assets, the standard metric for bank profitability, is roughly 1.1%. That means on $500 million in assets, you are clearing about $5.5 million a year in net income. It is a slow, steady, deeply boring profit, but you are constantly terrified of a cyber attack. You are exhausted by the annual regulatory exams, and your board of directors is aging. Eventually, the compliance costs get too high, and you sell the entire bank to a regional competitor for a moderate premium to your book value, ending your career as an independent banker. Scenario 2. The global mega bank. You are sitting at the helm of an institution with $3 trillion in assets. You have complete economies of scale. Your technology budget alone is $14 billion a year, which means you do not rent your software, you build it, and you use it to crush the smaller competition. You are completely diversified. When the yield curve inverts and lending becomes unprofitable, your investment banking division makes billions, taking tech companies public. When the stock market crashes, your wealth management division makes billions charging fixed advisory fees. You hold so much of the global financial system's plumbing that the federal government implicitly considers you systemically important, which is the polite regulatory term for too big to fail. Because everyone knows the government will never let you collapse. Large corporate depositors flood you with cash during a crisis, meaning your cost of funds is the cheapest in the industry. Your return on equity hits 15%. You're generating $40 billion a year in pure net profit. You're not just playing the game, you are the infrastructure of the game itself. That is the actual economics of owning a commercial bank. It is not a business about locking physical money in a steel vault. It is a business about managing the gap between the promises you make to your depositors and the promises your borrowers make to you. Sitting inside a highly leveraged, heavily regulated digital ecosystem where the fundamental product you're selling is trust. Build it right, and you own the beating heart of the capitalist machine, taking a tiny fraction of a penny from every economic action happening in your city. Build it wrong, mismatch your durations, misjudge your real estate collateral, or lose the psychological confidence of the public. And you will find out exactly how fast a digital bank run can wipe out decades of wealth, usually before the federal regulators even have time to pick up the phone.